I'm Michael Zayas. Thanks for taking the time today. Hopefully you learned something. I want to make this fun and informational. I'm based in Phoenix, Arizona, and I'm going to be talking about different factors in the market. You know, nobody can clearly predict what the future is going to hold, but obviously there are certain things that you can do to protect yourself, your clients, your friends, your family. People are still joining, so welcome again. Hopefully you were able to get in without any problems. I did see a calendar invite went out at an earlier time, so I apologize for those of you that might have wanted to join earlier. Again, Michael Zayas. I am the managing partner of Citizen Capital. Citizen Capital has a couple different entities, and I'll talk more about myself later, but why don't we get into it? So, you know, I see some of you guys that I know and some of you that I'd like to get to know better. You know, we're obviously all trying to do what we do best, and you have to know what's going on within the market and what factors might affect our business. So I want to talk about the real estate landscape and what we're seeing, factors that are causing some of this, you know, seen and unseen, things that I've seen anecdotally and things that I'll share. And then what some of the institutional groups are doing and how we can take that same approach with our own finances and, you know, with the way that we are approaching the market today. And then we'll have some questions and answers. So, you know, for any of you guys that invest in real estate, are adjacent to real estate, you know, service the industry, the market swings have been so dynamic in the last couple of years. I mean, prior to COVID, then with the stimulus, then with inflation, it's been sort of incredible how much it's impacted, you know, and certain markets have lagged. Other ones, you know, are kind of in lockstep with the stock market. You know, starting with some simple sort of no-brainer changes in commercial real estate, for example, just the rise of the remote work. You've seen what it's done to office. Globally, you know, office is struggling. Obviously, there's some outliers. There are some cities where it's working better than others, but, you know, office is in a tough spot, and people in the space are trying to figure out what they can do to create value there. You know, you might see in San Francisco office buildings trading for 60 cents on the dollars, and then other ones that, you know, are just finished being built. So there is this sort of dichotomy at the same time, but, you know, office demand is, you know, a fraction of what it was just a few years before the pandemic. There was already a shift to downsizing and having smaller spaces, and you saw WeWork come in and do some disruption, even though they've had, you know, a lot of problems on their own. But you know, office, it's just changed, and it's a good example. You'll see headlines where banks are selling portfolios of commercial real estate, and when you dig into it, it's mostly office and some retail kind of mall type real estate. With e-commerce, you've seen industrial building and need for space just really blow up in a good way. And I think you'll continue to see that even though, like in Phoenix, where I live, there's a massive pipeline of industrial buildings coming online between data centers and food distribution and goods in major markets. You're just going to continue to see a need for that. The problem with industrial is that land bases rose so much with all this stimulus in the market and inflation that sometimes if you can't get your land deal right, then it doesn't make any sense to do industrial. But that's you know, one of the kind of drivers still in the commercial real estate market. Some of my background was actually in senior living. I did quite a lot in the years past, and it's an interesting market. It's very niche. You've got demographics that are on your side, But the problem is that, will baby boomers and following generations want to live in the same type of facilities that previous ones did? So I think you're going to see a mixing of some business, like hospitality and senior living, almost like a Club Med of senior living. That's one of my predictions. As of right now, depending on what markets you're in and what niches, senior living can still be, a good play, a good investment. And I would definitely lend on it. In Arizona, you see a lot of senior living facilities and even smaller, sort of like mansions that people will put multiple people in it and run it really efficiently. And there'll always be demand for that, especially if you can do it at an attractive rate for a senior who's needing nursing care to live. I was just actually in Brazil for 2 months because the summer is too hot in Phoenix to stay. And we lived in a really nice tower in a nice area of town. And this apartment, condo apartment, hotel condo, actually had nursing services there for some of the residents, so the people could stay in their homes and live there. And I think you'll see more of that in the future. And then, apartment has been the darling lately. Multifamily has been really strong, partly because with interest rates up and with banks tightening their lending requirements, it's been hard for a lot of people to qualify for a home or to save up that much money with student loans and some of these various things. Anybody in the real estate market knows a bit about this, but one of the things about multifamily as well is, you see older classes of multifamily, the vintages in the 50s, 60s, 70s, and then you've got 80s, 90s, and then you've got some of the newer product. And today to build, it doesn't make sense a lot of times on a cost basis to build anything other than Class A. So then you're seeing people being priced out of, attractive areas. So in a lot of markets, apartments can still be very attractive. In other ones, there's a lot of product that's come online. I know Phoenix, rents have been down across the market, but there still seems to be some stickiness there. I want to share this map. I actually shared some of this on Facebook recently and thought, or not Facebook, on LinkedIn recently, and thought this was interesting. PGIM is Prudential's real estate group, and they have determined that these markets that are circled here, which I found interesting, that are mostly in blue states, there's some red states like Nashville and Raleigh, and but that they determined that these were more stable markets. So what this shows is sort of a shift from growth markets to an entrenching back to stabler markets. If you're putting out the type of money that PGIM puts out, they're trying to get out in front of trends. And I want to show you guys this, just see, sort of where some of these big guys are going, so goes the market. And obviously, taxes are important when you're doing a lot of growth, but when you're trying to just keep money, maybe being in Minnesota or Philadelphia or New York or Boston, maybe you pay higher taxes because the demand's going to be there, and what's causing the demand is it's the jobs. So that's how I'm reading this data. This other graphic shows a little bit more about just where values have gone in each of these different markets. And here is another graphic that just shows list prices moving and what direction that they're moving in based on the different metros. So you'll see that what this is showing is that there's sort of a pullback of growth, that new product is coming out maybe at a discount to where it was last year. So if you are an investor and you're trying to put money and have it backed by assets, you have to be careful what markets you're in, and then also be aware that if you're investing on the ownership equity side, that there's a real chance that the property that you buy might be worth less in the coming future, at least for a period of time. Some of the factors that have been influencing this volatility, it's political, it's industrial, in the industry, and then it's also what's happening with different companies. So, following the headlines, we have some of the highest corporate debt right now and individual debt. And then, we've got real estate prices that are up. So it's people are talking about recession. I don't want to be a Debbie Downer, but I also want to just share what I'm seeing in the market. And obviously when we printed the type of money that we did, inflation got out of control, and the government has tried to do everything that they can to bring that back. It's been priced in for a long time. So everybody has to be mindful about, what that is, how that's going to continue. This graph shows over the next 12 months, what is driving a lot of the volatility. And, I'm going to make a case of how to prepare yourself and protect yourself against this volatility. So, GDP growth, the United States benefits from all these other countries using our dollars and trading with us. We still have very strong GDP. You're seeing countries like China having negative GDP or a huge slowdown for the first time in a long time. And, being in a connected economy, things ebb and flow, and cash flows come around. And you'll see that, real GDP is expected to slow down, and this is essentially what a recession is, right? This is showing forecasted versus real GDP, sort of everything going in the wrong direction. So skipping through all the bad news, what are large institutional groups doing? I like to, I don't know how many of you guys are on LinkedIn or Twitter. I like to follow large investors and some of these large companies, some of their executives that share their data and post a lot, just all as signposts so that you can build a framework at a national level of what's going on and be aware. And, some of these guys, they really do have more data, and they have access to certain things that maybe the average person doesn't, and it allows them to sort of peek around the corner and see what's coming. And so I'm going to share some of that. Here are a couple of my posts from LinkedIn where I reshared. This first one is from Salida. She is the CIO for UBS Global, and she's talking about how private credit has just been in super demand at the institutional level. So if your parents have a pension and somebody is managing that, those allocators are putting money into private credit, where they are putting money into companies, or they're putting money into real estate or other asset-backed opportunities. So again, just another data point showing that some of the larger groups are transitioning from, trying to take as much money off the table because there's growth that's going to support it, to now let's be more cautious and make sure that we protect every dollar. This next one is Oaktree. So Oaktree is in the private equity space, so not necessarily real estate focused, but they also are raising large amounts of money to be the lender to some of these operators and companies that have interesting strategies. So instead of trying to be an investor and join the team and grow it, and them making money off the delta, the growth. Instead, they're giving money with conditions and saying, hey, if this doesn't work out, at least we'll get paid back, but we're hoping that this money and our expertise will help you. So it's a little change in strategy. This next post is about family offices being on the sidelines. And so I'll just define a family office real quick and then tell you some of my anecdotal experiences. So family office is a term for a family that has made a certain amount of money, usually over 200 million. And once they get above $200 million in assets or in cash, they bring some of their advisors in-house. So instead of having money with outside people, they bring it in-house and they manage it and become like their own investment firm. And they're exempt from certain things because it's all family money. They're not raising money from third parties. So that's what a family office is, if there's any of you guys on here that don't know. And anecdotally, with some of the families I know, a lot of them are very cautious. They're not being driven by return right now. Instead, they're being driven by security. And it makes sense. When there's volatility, people will always reach for security. I thought this was a really interesting post, and I'm sorry that the writing is so small that you probably can't see it, but because interest rates have gone up so much, it's hard to make certain deals pencil, because what would have been maybe a spread, like a lot of developers, they'll make maybe 2%, 3% on an entire project. And if interest rates have gone up like they have, meaningful in the percentages range, then that eats into the return, and then it doesn't make it worth taking the risk on the front end to buy land, improve it, and lease it up and turn it. So obviously there are some places where that's still happening. There are places where people have had land for a long time, or they might have a different strategy that allows them to have larger returns. But it's just in general, with interest rates and inflation up, costs are up, yields are tightened, and for a lot of people it might not be worth it to take the risk of developing or taking strategic value add properties. And last thing I wanted to share about what institutional groups are doing is a lot of people are going into some of this new tech like AI and quantum computing. And it's interesting to watch how this space is going to affect everything that we do, right? I'll share real quick, for my own loans, I have just engaged a group that is working with me, and we are close to an MVP where AI will allow a borrower of mine to upload all of their documents and then scrape the information from it and put it into a format that I like to see. Because one of the hardest thing as an investor or a lender is when you're looking at someone else's deal, people think about risk and return and what's important in different ways. And people, you can send out 10 pitch decks and each one is different. So as a standardization tool, as a time-saving tool, it will do a number of different things that will take, an initial meeting all the way through talking about pricing and terms and scoring for risk management. So this is going to be really interesting to watch. And, if anyone's interested in talking more about this, because it's kind of a side talk, let me know and reach out to me afterwards and we can dive into it a little bit further. I wanted to talk about this slide a little bit just to show, again, this is showing equity stocks. So where you're owning a property versus the stock market. usually when people get into real estate, it's because they want some of their money to be tied to something that's not affected so directly by the stock market. But when you invest in something like a real estate investment trust that's a public vehicle, one of the good things about it is like a mutual fund or a stock, you can put your money in and you can pull it out, relatively easily. You have some liquidity there. So it's not like buying a property and then you have to wait for somebody to buy it from you. It's much easier to put money in, spare money and pull it out. But you'll see here that the returns have just been really flat and are even less than what you could get if you were just putting your money in a bank account. There are certain money market accounts now that are paying in the 5s. I included this slide just to show, even on the private equity side, that even buying and selling businesses like real estate is also down. So the transactional volume is down, from institutional money. So what this is telling us is that some of these guys with a lot of cash on their balance sheets or in their company or in their fund, they're on the sidelines and they're watching and waiting to see what's going to happen. So, and which leads me to some of my pitch is that people, when they think about investing in real estate, they always think about owning an asset, but you can get better than market returns, have it be uncorrelated from the stock market, and have predictable income, security, diversification, all as being the lender and joining with a lender, being a lender to the lender or joining into the lender's fund. And you're essentially the bank, and you're the bank on these properties, and the bank always gets paid back first and is usually in a very safe position and has a lot more collateral than what they have their money out. So if anything happens, there's always some protection. So that's what I'm interested in doing with my investors. I can offer an investor up to 10% return, and they are a lender to me, and I can turn around and lend to some of the clients that I have, all backed by real estate. I don't take a management fee, which I think is interesting to share with people. If you look at 5 sort of investment deals where you're investing with a manager or fund, almost everybody takes a management fee. So that's where they get paid before they pay investors. We don't do that. What we do is if we're borrowing it at 10 and we lend it out at 12, we'll make the difference. So we get paid after we pay our investors back. And I should use this time to talk and introduce myself again, because people have joined since the beginning, but I'm Michael Zayas. I'm the managing partner of Citizen Capital. I started in the industry in 2004 in the mortgage industry and ended up getting a master's of real estate development where I focused on finance in 2011, and really started on the development side, on the sponsor side, borrower side, where I was working with banks to lend to me. And now over time, I've started other funds. So I'm a partner in another equity fund, started a couple debt funds, did a cross-border fund where we were taking capital and a company, a hospitality company from the United States, backed by Blackstone, into Latin America. It's given me a lot of experience and given me sort of an unorthodox path, but it allows me to be a really good lender, because not only do I understand the projects or the real estate, but also, being the borrower and figuring out a way to structure an investment as safe as possible for everybody, but also where it ensures the highest likelihood of project working out. And I can talk a little bit more about that. My sweet spot and what the fund is set up to do is to play in the sort of middle market, small business area where we're not competing with institutional guys. You know, we're doing loans maybe from the $3 million to the $20 million size. I would say right now, my typical loan is around $5 million, and can go higher than that. You know, in this space, this is where family offices and other private funds will play. You get lower than that, you'll also have some individuals that will lend, you know, and maybe this is for like some single family home development or fix and flips. I only do commercial. I will do residential when it comes to apartments or you know, single family home development of like a community and built to rent communities, but I'm not doing the fix and flip type loans. And what I've found is that you end up, it can be, the loan size can be larger, but you end up working with more sophisticated borrowers. So while you might look at a larger loan being a bigger risk, you're also working with individuals that have much longer track records, have bigger balance sheets, you know, better credit scores. That's always a nice one. That might have multiple properties that they're putting up as collateral. So I think the trade-off is that there's this sort of white space where the loans are too small for institutional groups to be interested in doing it on their own. And then it's too big for some of the smaller groups to be competing with you on price or expertise. So it's a good niche to be in. And like I said, I mean, family offices also operate in this space, but a lot of them are kind of sitting on the sidelines. So, you know, I know I've got tons of pipeline, lots of opportunities to put out capital, and with some great sponsors, with, you know, great locations and good business models, and you know, lots of equity in the mix. If I had to describe our sweet spot, it would be working with borrowers that were doing some value add or some opportunistic properties or projects. And you know, to define this a little further for some of the people on the call, if there's people that are not in the real estate space, you know, core, think of your office, your retail, and you know, maybe apartments. And these are the type of products that they're usually lease driven. So it's a building with leases in place, and there's very little risk, but then sometimes the returns are not that great. Value add means that somebody's bought a property and they're improving it. So there might be a little construction, there might be a point in time where they're making less than they were when they bought it because they're spending money to improve it and then make it better afterwards. And then opportunistic might be where somebody finds a portfolio and it's been undermanaged, and they're able to just turn it around, and you know, are able to based on their operational alpha, or based on their ability to find deals, they're able to do something that there's not as much competition in. So where I'm seeing a lot of promise today is still in some of these growth markets, but with you know, a primary look at, you know, Arizona, where I'm based, Colorado, Texas. Texas is still super strong, and the demographics there are great, as are Nashville. And then I've been doing quite a lot in the Carolinas. I still like Boise. There are these pockets around the country that are still experiencing a lot of growth. And then you marry that with a very experienced borrower or an interesting strategy. This is just a couple of reasons why people like investing in debt as well. There can be tax benefits. There's cash flow. You know, over time too, as you're getting paid your loan down, and if you're in a good market and there's still some growth, there's even more equity behind you and you have more security. So here's some of the terms of the fund. Initially, when I went to market, we were looking at a $50 million raise based on some demand and some larger check sizes that have been interested. We're raising that to 150 million. Right now, I am going to commit to paying investors 10%, whether you choose a 1-year note, a 2-year note, or a 3-year note, up until a certain point, to get some dollars in the door. But going forward after that, the structure is, as we get to know each other, you can pick your terms. So you can choose to be part of the fund for a year, and then at the end of the year, you get your money back with interest, or you can choose a 2-year or a 3-year. And the way that I set it up is everybody gets paid 7% a year. And then if you do a 2-year, you get a payout when we pay you off, so that it averages a 9% a year return. And the same goes for the 10% on a 3-year. And the reason I set it up like this is, as a lender, your cost of capital, what I have to pay investors, and I shouldn't say have to pay, what I get to pay investors is sometimes a factor of whether you can land a borrower or not. If you're not competitive, you might have to take more difficult loans, or you might not be able to land somebody that has a really good relationship and is able to get better pricing from somebody else. So it is part of the function of it. And then as well, some of the loans, if we can, I'll do my pricing the same way, where they get a lower cost of capital through the first year and a half or so, and then they have to pay more on the exit. But what that helps a borrower do is they get through this J curve where, sometimes you buy a property and you start improving it, and you're not making any money yet, and then it's worth a lot more afterwards. And structuring the pricing like this just allows a better deal for the borrower, which allows for more likelihood of it going well, which allows more security for the fund and for our investors. So I wanted to explain that, and I can always bring that back up too if somebody else wants to talk about that. So when we raised the fund size from 50 to 150, we raised the minimum subscription amount as well. And this is going out to some family offices, some other groups that have been sitting on the sideline that I'm trying to get back in the game. And I have the ability to take smaller check sizes. So that's something, if somebody's interested, I've got somebody coming in at 100,000 and another person coming in at 50,000. Obviously, it's better to have accredited investors that are putting in larger check sizes. So you're not having to manage, 1,000 people, maybe it's 100 instead. So I wanted to talk about that. And I'd also say that investors, they will start getting their return in the second month. So we'll call capital, and then we invest it, and then it takes about a month to get it back from our borrowers. So we just build in a 60-day window to say, expect to get your first dividend after that. And I'll mention too that we have third-party fund administration, which means we have a platform that investors can go into, and at any point in time on their phone or on the computer, they can see where their dollars are. All the wires go in and out of there so that it's secure, and all the reporting is done by the third-party fund administrator. It's just another way to be more transparent and have accountability. and they'll also do some of the K1s and the tax prep for the fund. So the great thing about investing in debt is that you have security. The great thing about investing in a debt fund is that you have security and you have it diversified over other properties. So, we'll have geographic diversity, we'll have diversity by asset class, we'll have diversity in, the loan sizes. And this all helps hedge an investor from having their money exposed to the swings of the stock market, or the pen of Jay Powell, who's always a bit of an enigma. And the other thing is, you can reasonably know what your return is going to be. It's a fixed income every single month. A lot of my investors are retirees or guys who have started businesses and done really well, and now they just live off the fixed cash flow from some of their investments like this. So, you might be in different stages of your life. Maybe you're younger and just wanting to put something somewhere so it's not in the bank account, or you might be, sitting on cash and trying to figure out what to do with it, and you don't want to lose it. Investing in debt and having it backed by collateral is the best that you can do right now. So, I have a little bit of information about what it looks like to bring on a loan. And I mentioned AI previously. We're already using some of it to streamline a process of onboarding project. This is sort of the lightning fast version. Usually from start to finish, we could talk about 30 days, just to give everybody a little bit of breathing room, because you have to work with title and escrow and other parties, legal. But we take our borrowers through a clear process and communicate the whole time. And we always do a site visit to make sure that everything that has been shared with us, we verify it to make sure that it is as it is. So if you're interested, join the fund, talk to me about it. I'd love to set up a one-on-one and get to know you. I saw some of you guys that signed in that we've known each other for a while, and other of you that we've known each other and then maybe we've lost touch. So I'd love to catch up. What we do is we let people register on our portal, and then you can start to take a look at the fund, or actually individual loans too at a property level that you can invest in. So at this point, I'm going to open it up for Q&A if anybody has any questions.
Hello, Michael. How you doing?
Hey, Derek. Good to see you.
Quick question. What is the minimum investment amount?
Yeah, so you and I can talk about it. Like I said, right now the smallest I have is 50,000. But we can talk about it. We are taking investors from all different sizes at the moment.
Thank you.
Hey, Michael, Kranti here. How are you doing?
Good, yourself?
Good. So quick question. How are these funds protected, right? From our end, let's say example, I would like to invest around 100K or 200K essentially, just picking the number, right? So how are we protected on the investment standpoint, right? From the LLC standpoint, right? And in future, right? Someone files for bankruptcy in your whole supply chain, essentially, right? So how are we protected in that regard, right? How is that hard-earned money is protected?
Sure. So the fund signs an agreement with the investor. So let's say you, for example, for 200,000, we sign a promissory note. So that note is binding. You'll also sign the PPM to join the fund. So the PPM is a private placement memorandum, and there's a subscription agreement. So you're saying, I want to join the fund and join in the mission of lending to real estate developers, real estate entrepreneurs. Once the money's in the fund, we turn around and lend to, developer X, and we've got a promissory note with them, and we own their property if they don't pay us. So if we have to, we can foreclose on the property. Thanks for bringing this up, because I didn't mention it earlier, but the geographical areas that we go into, if you notice, most of them are in non-judicial states. So what that means is if you have to foreclose on a property, you can do it more rapidly. In a judicial state, you have to go before a judge, and it's scheduling out, could be months in advance. And all that time, you're not getting paid. Granted, you are accruing default interest, which is like 30%. It's the only time that you can be paid interest above what's usury in most states, is if that person is in default. So given my skill set in real estate development, acquisitions, I'm not worried if we had to take a property back, but that's never the plan. We want to put money out, get a modest return, make sure all of our investors are happy and get paid off. And I didn't talk about it that much on this webinar, but a lot of the borrowers that I work with, I'm offering debt as a bridge while they're waiting for a bank to, do all the paperwork. So I've got a borrower who does a lot of self-storage, and he will apply for an SBA loan. And the SBA loan can take anywhere from 9 months to a year. And in that time, I can help him buy the property, improve it, and then I'm getting taken out with the SBA loan. So I already know where my exit's going to be. I already know, more or less when the timing is going to be. I'm just helping between point A and B. And that's the best way to lend the money out. So I hope that answered your question.
Absolutely. Sure, Michael.
And I'll mention too, like I lend to a car wash company. They are a subscription-based car wash company. You pay like $20 a month and you can go as many times as you'd like. And they do so well. They make so much money. And when I borrow, or when I lend to them, the borrower is a corporate guarantor and the LLC that owns the specific store, and the corporate guarantor sometimes has 20 stores. So if the local store stop paying me, I have the corporate guarantor that from its 20 stores can pay me, or else I can go and take 20 stores, so it's the ultimate incentive for them to pay me. So, on the legal side, we have best-in-class attorneys that represent us and write all over our loan documents and agreements.
I have a question. So do you so you are a company, do you invest on other projects? And if I have a project that's looking for equity investors, is that something that you do also?
No, at this moment, we're not doing equity. We're just, any money we're putting in is going to be secured under a loan.
Okay.
So like if you had problems with a bank, like right now, my banker was supposed to be on here, so I didn't talk anything about the banks, but he's not on. So like a bank for a development loan, you might be paying 9 to 11% in interest, which is basically almost what I'm lending out at. And they're going to want full recourse, and they're going to, if anything goes wrong, they're going to take your house and your car and everything that you own. But they're also only going to lend out maybe 50% or 55% of what the project needs. I could probably go up to 70, and that 15% is a big deal, especially if the capital raise is slow for equity, which is sort of true in the market right now. Obviously, good deals get done, but I have done equity in the past. I will roll out future funds. And then when investors get on my portal, I will also show other deals that come across my desk, that I can share with investors, and some of them are equity. I have relationships in that space, that have invested with me before. But at this point in time, I'm really focused on debt.
Okay, well, just in case you ended up doing those things, I do have projects. Would love to connect with you, Michael.
Sure.
So I have a lot of projects in Arizona and Texas, also in Florida. So if you open up that program, I'll be glad to connect with you.
Great. Darren, I see that you had some questions here. Yes, so typically when I lend, it's non-recourse. So if I needed to, I could only go after the property. That's sort of the difference of recourse versus non-recourse, guarantee versus not having a personal guarantee. At times there's been a personal guarantee, maybe for like the top 10% or 15% of a loan, just to protect the lender. But typically it's non-recourse with carve-outs from the borrower in cases of for fraud, stuff like that. Do all loans close in the name of the fund, or do you assign them to the fund? Yes, they're assigned to the fund. So usually we'll create another LLC for each loan that kind of houses it, and then the fund has the ability to step in as the beneficial owner and as assignee of it. So it's also another layer of being able to silo your risk, so that the loans aren't all tied together. Other than C&D, are all your loans bridge or other? What general maturities, LTVs? Yes. So I'll do C&D, construction development. I'll do bridge. We've done some land. We've done I'm trying to think, and usually they're not term loans or anything like that, if that's what your question was. We're in there short term. Typical loan is 12 months and can extend to 18 or so. That one car wash client that I had, they had enough cash flow from their store that we just kept extending it. And they weren't bothered, and they would rather stay with us than work with a bank. So we kept it going. If that didn't answer your question, you can ask me afterwards. Will you make the slides available? Yes. So the slides will be available. Everybody that joined should get a replay with the slides. Was that everything, Darren? Was that good? Okay. Anybody else?
So how would you give a loan to a new person? So I think, so you are saying you would be giving loans to developers and stuff like that. So in the context of where you mentioned a car wash business owner or someone who is trying to get a loan from a SBA bank, like SB, Small Business Administration.
Yeah.
What are the things that you check? Are they known to you personally? Are they known to you? You are somewhere in Arizona, let's say someone in Texas or Florida applies to you loan. How would you check that? I'm just curious.
Sure. So you're asking about our underwriting process.
Yeah, let's say I'm just knowing your company today by webinar. Let's say I want to apply a loan with you. So what would you look for? I'm just trying to see what are the things that you look for when you're kind of giving loan to someone, in the context of your car wash or in the context of someone getting a bridge loan from the SBA.
Yeah, so with my car wash, it's a little bit different because I've been working with those guys 10 years or so. But if it's a new person, having a loan summary or executive summary is really helpful. Where the property is, what it's being purchased for, are there purchase and sale agreements that are already agreed to, preliminary title work that's been done. What is it going to be used for? Is there a budget if there's any renovations or if it's a development loan? Those are sort of the main pieces of it. Then, we work with title and escrow. They do a thorough vetting of the property itself to make sure, that we know exactly what the loan is that's there that we have to pay off or refinance. If there's other liens, we want to know if it's construction, who the GC is, because they can also do liens. Sometimes, there have been borrowers that started some work before our loan closed, And then we have to do a whole nother process with title with every single draw. So that's the gist of it. We always do a site visit. So we go out, we meet with the borrowers, we see the dirt or the building. We want to see, leases, if it's, a building, if they're leasing up and, maybe they need more tenants in there. We'll always look at their P&Ls if it's an existing business with a building. So that's just general, but we'll do credit scores from borrowers, because if it's true for somebody buying a car, it's true for somebody borrowing money for a credit card and for real estate. Somebody could have poor credit and still be a great real estate operator and fix and flipper, or operating at a larger scale, but typically it's not the case. Some of the loans that are more challenging are the ones where that borrower didn't have as good a credit score. And so that's kind of an indication or a red flag there. So we've got a whole criteria. And again, the AI tool that we're building will actually help populate all of that. And if something's missing, then we'll go through and ask the borrower to provide more information.
Gotcha. Thank you. So you typically lend out to like the car wash companies, and who are the most common customers?
Yeah, so I'm doing quite a lot of townhomes right now, townhome development in Boise and Arizona. I'm doing the car washes in Texas and Oklahoma. I mean, just with the car washes alone, I could probably put out $50 million. With some of the apartment users, I'm talking with a apartment user out of Kansas City that has, call it probably 2,000 units, and they need to recapitalize some of them, so it'll just be a bridge loan. So I'd probably be having collateral of about 200 apartment units. Besides for that, I'm also doing self-storage, like I mentioned. And there's a couple of coffee chains that I've worked with before, and it's helping them take down the dirt and then build the building. And once the building's open and ready for business, we're paid off by a bank.
Gotcha. So do you work with the Hurricane Express car wash or someone else?
I haven't heard of them, so
Oh, okay.
Yeah.
Yeah, okay. So I attended one of their deals. So they're kind of have like a 25 car wash company, and they're trying to expand. Like, what is do you mind naming the company that you are working with, the car wash company?
Yeah, these guys are called Watershed.
Watershed.
Yeah. And in fact, the guys that I work with, they built up a portfolio to about 25.
Oh,
Sold it to private equity.
okay.
We invested in and are now doing it in another state. So
gotcha.
top tier.
Gotcha. Yeah, the one I talked with was also Hurricane Express. They are based out in South Carolina, and they recently acquired 2 car washes in Texas, and they're trying to expand in Texas. I am from Texas. So I'm just curious whether it is the same company.
No. Did you have any other questions?
No, I'm good for now. Thank you.
Okay. And I saw Paul, what states do you invest the most? So I'm doing a lot in Texas, a lot in Arizona, staying away from California, like Boise, looking in the Carolinas a lot. And what type of properties? So I don't know if you heard what I was just talking about. I am lending. Currently, I have not been investing equity or cash on my own for a couple of years. I am a partner in a fund that has some mobile home parks. I do like that space because it's not overcrowded. What you've seen lately in apartments have been like the new seminar type of buying frenzy where, mom and pops were getting into it and buying multifamily and driving the prices up. And there's just a lot of competition for that. Mobile home parks are a little bit different. My partner's strategy is different, where he buys overlooked properties that, just are unloved. Nobody's put money into them in a long time, and they could be much better than they are. And the rents could be much better than they are. And you can put more units in them. Sometimes they're only like half full. And so we'll buy them, clean them up, put new units in. And, all of a sudden it's worth 3.5 times more than when we bought it. So that's about all I'm doing. And that's, we're doing that in Nevada and in South Carolina and in the Midwest right now. But I'm a little more passive. I'm just, on the investment committee for that. All right, guys. Well, if there's anything else, you can always email me or shoot me a text. I think my contact was in there. I'd love to catch up, and I'm going to drop my email in the chat right now too. All right, everybody. Thanks for coming. Have a great weekend, and reach out and let's schedule time to talk. All right.